Right now, as you watch this video, the Shanghai Futures Exchange silver vaults are bleeding. Not leaking, bleeding. In the past 18 months, registered silver inventory in Shanghai has collapsed by 73%. 73%. We're talking about the world's largest physical silver trading hub, the exchange that moves more physical metal than anywhere else on Earth. And it's been systematically drained while Western investors scroll TikTok and check their index funds. The Shanghai Exchange held over 9,000 metric tons of registered silver in early 2023. Today, less than 2,400 tons. That's not a drawdown. That's a bank run in slow motion. And here's what should terrify you. During the same period, COMEX inventories in New York barely moved. They're sitting at roughly 300 million ounces, seemingly stable, seemingly safe. But here's the thing, nobody's connecting. Shanghai moves physical metal. Real bars, real delivery, COMEX. 97% of COMEX contracts are cash settled, paper promises, financial fiction. So while the East drains the physical, the West trades pixels on a screen. Industrial demand for silver has exploded by 42% since 2020, driven by solar panel production that now consumes over 160 million ounces annually. Electric vehicle electronics requiring 0.6 ounces per car, with EV sales doubling year over year in China. And military applications, where a single Tomahawk missile uses approximately 500 ounces of silver. Every AI server farm, every 5G tower, every semiconductor fabrication plant is a silver vampire that never stops feeding. The Silver Institute projects a supply deficit of over 200 million ounces for 2024 alone. That means the world is consuming 200 million more ounces than it's mining. Every single year, this isn't sustainable. It's not even logical. And yet silver trades at $28 an ounce while gold sits above 2,000. The gold to silver ratio is hovering near 85 to 1. Historically, that ratio has averaged 15 to 1. Something is catastrophically broken. Who is draining Shanghai? That's the question that keeps me up at night. Because this isn't random. This isn't market forces finding equilibrium. This is systematic accumulation on a scale we haven't seen since the Hunt brothers tried to corner the market in 1980. Except this time, it's not two billionaire cowboys from Texas. This time, it might be the Chinese government itself, acting through state-owned enterprises, quietly building strategic reserves, while the Federal Reserve prints dollars and calls inflation transitory. The Chinese State Council released a directive in 2023 encouraging diversification away from dollar-denominated assets. They didn't specify silver, but they didn't have to. The Shanghai inventory numbers tell you everything you need to know. While Western central banks hold 22% of their reserves in gold, China officially reports less than 4%. Officially. That word matters. Because if you're China and you're preparing for a potential conflict over Taiwan, a trade war escalation, or a complete decoupling from the Western financial system, you don't announce your strategic metal accumulation on CNBC. You do it quietly. You do it in Shanghai. You drain the exchange, and you don't explain why. The mainstream financial media isn't covering this story. Bloomberg mentioned the Shanghai drawdown once, buried in a commodities roundup. The Wall Street Journal? Silence. CNBC talked about silver for 90 seconds last quarter, focused entirely on retail investor sentiment and Reddit forums. They're missing the story of the decade because it doesn't fit their narrative. It doesn't fit into their comfortable world where markets are efficient, where prices reflect reality, and where the post-World War II financial order continues forever unchanged. But markets aren't efficient when 97% of trading volume is paper contracts that will never see physical delivery. Markets aren't rational when industrial demand creates structural deficits that price discovery mechanisms refuse to acknowledge. And the financial order isn't permanent when the world's second largest economy is actively, aggressively, systematically moving away from dollar dependence. Why is Shanghai being drained while the West sleeps? Because the West isn't sleeping. The West is trapped. COMEX can't afford a physical delivery crisis. The big banks, the ones holding massive short positions in silver futures, they can't allow price discovery to shift from paper markets to physical markets because if it does, if investors start demanding actual metal instead of cash settlement, the entire pricing structure collapses. We saw glimpses of this in March 2020 when COVID shut down refineries and the spread between paper silver and physical silver exploded to $8 an ounce. $8. Imagine buying a COMEX contract at $17 and discovering that actual 1 ounce rounds are selling for $25. That's not a market. That's a broken pricing mechanism, held together with duct tape and prayer. The urgency here isn't theoretical. This isn't a maybe situation. The math is simple and brutal. Global silver mining production has been essentially flat for a decade, hovering around 820 million ounces annually. Recycling adds maybe 180 million ounces. That's total supply, roughly 1 billion ounces. Now let's talk demand. Industrial applications consume 600 million ounces. Jewelry and silverware take another 200 million. Investment demand, including coins and bars and ETFs, fluctuates, but averaged 150 million ounces in recent years. Add it up, we're consuming more than we're producing, and that deficit is accelerating as solar panel production continues its parabolic rise. China alone is installing solar capacity equivalent to the entire US grid every single year. Every panel requires silver paste for conductivity. There is no substitute that matches silver's efficiency at current cost structures. When you combine this structural deficit with the Shanghai inventory collapse, you're looking at a physical shortage developing in real time while paper markets pretend everything is fine. And here's where it gets dangerous. If you're watching this video, you need to understand something fundamental about modern commodity markets. Price discovery happens in futures markets, not physical markets. The price you see quoted for silver, that $28, that's not determined by someone buying actual bars. It's determined by traders exchanging contracts on COMEX and other futures exchanges. These contracts are leveraged, meaning you can control 100 ounces of silver with a fraction of the actual value as margin. This creates massive trading volume, massive liquidity, and it gives the appearance of a deep functioning market. But it's an illusion. It's a beautiful, carefully constructed illusion that works perfectly until someone asks for physical delivery at scale. Before we go deeper into what happens when the system breaks, I need you to do something. If you're finding value in this analysis, if this is the kind of deep financial investigation you can't find anywhere else, subscribe right now. This channel doesn't chase headlines. We don't report what happened yesterday. We show you what's happening right now that will become headlines tomorrow. We connect dots that mainstream media either can't see or won't touch. Financial truth isn't served to you on a platter. You have to dig for it. You have to question narratives. And you have to be willing to see patterns before they become obvious. Subscribe for market signals they don't want you to understand. Subscribe, because by the time this story hits Bloomberg's front page, the opportunity will be gone, and the crisis will be undeniable. Now let's talk about what makes this situation truly unprecedented. The Shanghai inventory collapse isn't happening in isolation. It's happening while Chinese industrial demand for silver has increased by 68% in 4 years. China produces 77% of the world's solar panels. They manufacture 60% of global EV batteries. Their semiconductor industry, despite US sanctions, continues expanding with fabrication plants in Wuhan, Nanjing, and Shenzhen, consuming metric tons of silver monthly. Every one of these industries is strategic. Every single one represents technology that China views as essential to economic security and potential military applications. Silver isn't just a precious metal to China. It's a strategic industrial input for the technologies that will define the 21st century. And they're making sure they have enough. Look at what happened with gallium and germanium. In August 2023, China restricted exports of these critical minerals used in semiconductor manufacturing. Within weeks, prices doubled. Western manufacturers panicked. Supply chains seized up. China controls 70% of global gallium production and 60% of germanium. They demonstrated, without firing a shot, that control over strategic materials translates to geopolitical leverage. Now apply that lesson to silver. China doesn't produce the majority of global silver. Mexico, Peru, and China are the top 3 producers, each contributing roughly 15 to 20% of global mine supply. But China controls the refining. They control the manufacturing. They control the demand side of the equation. And increasingly, they're controlling the physical inventory. The strategic accumulation theory isn't conspiracy. It's pattern recognition. When a nation-state systematically draws down exchange inventories while simultaneously increasing domestic production across silver-intensive industries, while simultaneously reducing dependency on Western financial systems, while simultaneously facing potential economic conflict with the United States, you don't need a classified intelligence briefing to understand the strategy. You just need to look at the numbers without bias. The Shanghai Futures Exchange doesn't publish data on who is withdrawing silver. They don't tell you if it's going to industrial users, to strategic reserves, to private vaults, or being shipped elsewhere. But withdrawal is withdrawal. And when inventory drops 73% in 18 months, someone is taking delivery at massive scale. Compare this to COMEX. The registered inventory, the metal actually available for delivery, fluctuates but remains substantial at around 120 million ounces. But here's the critical detail. COMEX also has eligible inventory, another 180 million ounces, which is metal stored in COMEX-approved warehouses, but not available for immediate delivery unless the owner designates it as registered. This creates a shell game where total inventory looks healthy, but deliverable inventory can shift rapidly. During the March 2020 squeeze, Registered COMEX silver dropped from 130 million ounces to under 90 million in less than 6 weeks. The exchange didn't default, but spreads exploded and premiums went parabolic. That was a brief liquidity crisis caused by refinery shutdowns. Imagine what happens when industrial demand combines with investment demand, combines with Eastern accumulation, combines with a loss of confidence in paper markets. You don't get a squeeze. You get a complete market structure failure. The industrial silver explosion is the part of this story that makes traditional supply-demand analysis obsolete. In 2010, industrial silver demand was roughly 450 million ounces annually. Today, it's over 650 million and accelerating. The solar industry alone is projected to consume 220 million ounces by 2025. Electric vehicles aren't just growing, they're becoming the dominant vehicle platform in the world's largest auto market. China sold over 8 million EVs in 2023. Each vehicle requires silver for circuit boards, contactors, and battery management systems. That's 4.8 million ounces just from Chinese EV production, and that number is doubling every 30 months. Add 5G infrastructure, where every small cell tower requires silver-based components. Add AI data centers, where server farms the size of city blocks run on silver-soldered connections and silver-based thermal management systems. Add military applications, where hypersonic missiles, advanced radar systems, and electronic warfare equipment consume silver at rates that remain classified but are known to be substantial. This isn't cyclical demand. This is structural demand that doesn't go away during recessions. When economy slows, solar panel production might decelerate slightly, but the energy transition isn't stopping. It's mandated by government policy across dozens of countries. The European Union, China, and increasingly the United States are locked into renewable energy targets that require hundreds of gigawatts of solar capacity installation over the next decade. Silver is the only material that makes solar panels economically viable at scale. Researchers have tried alternatives: copper paste, aluminum paste, carbon nanotubes. None match silver's conductivity to cost ratio in mass production. Until someone invents a breakthrough substitute, which has eluded materials scientists for 30 years, every solar panel needs silver. And humanity is installing solar panels at a rate of 250 gigawatts annually, accelerating to potentially 400 gigawatts by 2030. Do the math. Each gigawatt requires roughly 100 metric tons of silver. That's 25,000 metric tons annually, or roughly 800 million ounces, just for solar. We only mine 820 million total. But here's where it gets dangerous. And I need you to understand this because it explains why we might be witnessing the setup for the most violent short squeeze in commodity market history. The COMEX silver market operates on leverage that would make a cryptocurrency trader blush. Open interest in COMEX silver futures regularly exceeds 1 billion ounces. Think about that. 1 billion ounces of paper claims against roughly 120 million ounces of registered physical inventory. That's an 8-to-1 leverage ratio on a good day. During periods of high speculation, that ratio has touched 12-to-1. The system functions smoothly because everyone knows the game. 97% of contracts cash settle. Traders aren't trying to take delivery. They're speculating on price movements, hedging industrial exposure, or running technical trading strategies. The futures market isn't designed for physical delivery at scale. It's designed for price discovery and risk management. But what happens when that assumption breaks? Well, let's talk about the Hunt brothers for context. In 1979 and 1980, Nelson Bunker Hunt and William Herbert Hunt, two Texas billionaires, attempted to corner the silver market. They accumulated over 200 million ounces of physical silver in futures contracts, controlling another 100 million ounces. Silver went from $6 an ounce to $50 an ounce in less than a year. The COMEX, facing a potential delivery default, changed the rules mid-game. They implemented position limits, increased margin requirements, and eventually instituted Silver Rule 7, which restricted purchases to liquidation only. The Hunt brothers couldn't roll their positions, couldn't maintain margin, and the price collapsed. They lost billions, and the market stabilized. But here's the key lesson. The exchange changed the rules because the alternative was systemic failure. The Hunt brothers proved that concentrated physical demand could break paper markets, and they did it with technology and capital resources from 1980. Now imagine that scenario with modern capital, with state-level resources, with geopolitical motivation. The Hunt brothers were speculators chasing profit. What if the buyer is a sovereign nation accumulating strategic reserves? You can't margin call a country. You can't change exchange rules to force China to liquidate. And if physical delivery becomes the preferred method of taking position because trust in paper settlement evaporates, COMEX faces an impossible choice. Default on delivery, which destroys the exchange's credibility and potentially triggers a broader derivatives crisis, or allow physical delivery at scale, which drains registered inventory and forces cash settlement at prices potentially multiples higher than current spot. Either outcome sends silver prices into territory that current market participants can't comprehend. The GameStop analogy is imperfect but illustrative. In January 2021, retail traders organized on Reddit identified that GameStop stock had short interest exceeding 100% of free float. Hedge funds had borrowed and sold more shares than actually existed available for trading. When buying pressure increased and shorts needed to cover, price went from $20 to $480 in days. The system almost broke. Brokerages restricted buying. Clearinghouses increased margin requirements. Congressional hearings followed. But imagine if GameStop was a physical commodity essential to industrial production, military technology, and energy infrastructure. Imagine if you couldn't just restrict buying. Imagine if China needed that commodity and had the currency reserves to buy every available ounce regardless of price. That's the silver market structure right now. Massive paper short positions, structural physical deficits, concentrated buying, potentially coming from entities that don't care about quarter-over-quarter profit margins. This is the part nobody wants to talk about. The concentrated short position in silver futures isn't retail speculation gone wrong. It's institutional hedging by major banks that are short hundreds of millions of ounces through various derivative structures. These positions made perfect sense when silver was a stable industrial commodity trading in a predictable range. They make no sense in a world where physical inventories are collapsing and industrial demand is exploding. If these institutions need to cover short positions through physical delivery, where does the metal come from? Exchange inventories are finite and shrinking. Mine production is flat. Recycling can't increase meaningfully in the short term. The only answer is price. Price has to rise until demand destruction occurs or new supply emerges. But how high does silver need to go before solar panel manufacturers stop building, before EV production halts, before militaries reduce electronics and weapon systems? Probably a lot higher than $28. Supply deficit math is simple but brutal. The Silver Institute, which is about as mainstream and conservative as silver analysis gets, projects cumulative supply deficits totaling over 800 million ounces through 2027. 800 million ounces of silver will be consumed beyond what's produced. That deficit has to come from somewhere. It comes from above-ground stockpiles, from exchange inventories, from scrap recycling, from jewelry melted down, from coins sold back, from silverware liquidated. But above-ground stockpiles aren't infinite. The total identifiable above-ground silver stock globally is estimated at roughly 2.5 billion ounces. Sounds like a lot. But most of that is in jewelry, silverware, industrial applications, and forms not easily converted back to refined bullion. The amount of investment-grade silver readily available, including exchange inventories, ETF holdings, and sovereign reserves, is probably closer to 1.2 billion ounces. If we're running 200 million ounce annual deficits, that's 6 years until above-ground investment stocks are exhausted. 6 years. And that assumes demand doesn't accelerate, which it is. That assumes no panic buying, which is unlikely. That assumes orderly markets, which history says won't happen. Mining constraints make the supply problem unsolvable in the near term. Silver is predominantly a byproduct of copper, lead, and zinc mining. Roughly 70% of silver comes from polymetallic deposits, where silver is secondary to base metals. This means silver production doesn't respond to silver prices the way pure play commodities do. If silver goes to $50, but copper and zinc prices are weak, mines don't dramatically increase silver output. They're optimized for base metal extraction. Building new mines takes 7 to 12 years from discovery to production. Expanding existing mines takes 3 to 5 years for permitting and construction. There is no quick supply response. Even if silver hits $100 tomorrow, meaningful new supply won't arrive until 2028 at the earliest. And that's assuming mining companies believe the price will stay elevated, which recent history suggests they won't. Silver has had multiple price spikes that proved temporary. Mining executives remember 2011, when silver briefly touched $49, then crashed back to $14. They're not going to commit billion-dollar capital expenditures based on price spikes that might evaporate. What happens if physical delivery fails? This is the scenario that keeps commodity market regulators awake at night. Imagine COMEX receives delivery notices exceeding registered inventory. The exchange has several options. They can declare force majeure and cash settle contracts at the current spot price, which would be catastrophic for exchange credibility and would likely trigger legal challenges from longs demanding physical metal. They can allow delivery failures to occur, where shorts can't deliver metal to longs who demanded it, which would effectively be a default. Or they can allow the spot price to rise until enough longs accept cash settlement voluntarily and enough new physical supply emerges from holders willing to sell at higher prices. A third option is what happened partially in March 2020. Premiums exploded, spreads widened, but the system held together because the stress was temporary and demand side driven by retail panic buying rather than institutional accumulation. But a sustained physical delivery crisis would be different. If industrial users who normally buy from refineries start demanding COMEX delivery because physical premiums are too high, if sovereign buyers start standing for delivery on futures contracts instead of buying from miners directly, if ETFs see massive inflows requiring physical backing while inventories are already depleted, the exchange faces compounding pressure from multiple directions simultaneously. Each delivery drains registered inventory, making the next delivery harder, creating a self-reinforcing cycle where reduced inventory increases fear, which increases delivery demands, which reduces inventory further. This is how bank runs happen. This is how currency pegs break. This is how markets that appear stable for decades suddenly gap limit up for weeks straight. The path to $200 silver requires understanding both realistic scenarios and speculative extremes. Let's start realistic. If industrial demand continues current growth trajectory, if supply deficits persist at 200 million ounces annually, if investment demand returns to 2011 levels when silver ETFs saw massive inflows, we could see $70 to $90 silver within 18 months purely from supply-demand rebalancing. That's not speculation. That's arithmetic. The market would need prices high enough to slow industrial consumption through demand destruction while simultaneously pulling scrap and recycling into the market. Historical patterns suggest silver needs to reach 5 to 7% of gold's price to trigger significant scrap recycling. With gold at 2,000, that implies silver at 100 to 140. Now let's talk speculative. If Shanghai inventory collapse is indeed strategic accumulation, if China decides to announce silver as part of national reserves, if COMEX faces delivery problems that become public, if the paper-to-physical disconnect becomes undeniable and investment money floods into silver as a store of value during currency instability, you get cascading reflexivity, where rising prices create buying, which creates rising prices. In that scenario, silver doesn't stop at 100. GameStop went from 20 to 480. That's a 24x move. Silver at 28, going to 200, is a 7x move. It's dramatic, but not historically unprecedented. Silver hit $50 in 1980, and again, nearly in 2011. Adjusted for real inflation, 1980's $50 silver is roughly $175 today. So 200 isn't some insane moonshot. It's actually just matching inflation-adjusted previous peaks during supply stress. But we need to talk about risks and counter-arguments because credibility requires acknowledging what could go wrong with this thesis. First, industrial demand could slow if global recession hits harder than expected. Solar panel installation could decelerate if government subsidies are cut or electricity demand declines. EV adoption could plateau if battery technology shifts away from silver-intensive designs, or if economic conditions reduce consumer vehicle purchases. Second, above-ground stocks might be larger than estimated. Private holdings, central bank reserves not publicly disclosed, industrial stockpiles held by manufacturers, these could provide more supply buffer than current data suggests. Third, substitution could accelerate. If silver hits $70 or $80, research and development into alternatives gets billion-dollar funding, and materials science has surprised before. Copper-based solar paste or carbon nanotube conductors might become viable at scale faster than expected. Fourth, COMEX and other exchanges could change rules again. Position limits, increased margin requirements, restrictions on physical delivery, these are tools regulators have used before and would absolutely use again to prevent market disruption. If you're counting on COMEX default to drive silver to 200, understand that governments and exchanges will do everything possible to prevent that outcome, including rule changes that benefit shorts and harm longs. Fifth, China might not be accumulating strategically. The Shanghai inventory decline could be normal industrial drawdown, could be warehouse optimization, could be private companies taking delivery for manufacturing needs rather than state reserve building. Absence of evidence isn't evidence of absence, and we're pattern matching potentially random data into a compelling narrative. Sixth, mining supply could increase faster than expected if base metal prices rise alongside silver. Copper is showing strength, zinc has support. If polymetallic mines become more profitable overall, silver byproduct production increases even without silver-specific projects. And seventh, the paper market might never break. It's persisted through multiple price spikes, multiple supply squeezes, multiple periods where physical premiums diverged from spot. The system has remarkable resilience, and participants have every incentive to maintain the status quo. Betting on systemic failure requires the system to fail, and systems are usually more robust than bears expect. These counterarguments are real and serious. Anyone telling you silver to 200 is guaranteed is selling something. Markets are probabilistic, not deterministic. But the counterarguments don't invalidate the core thesis. They just add nuance and remind us that even strong fundamentals can take years to play out, or might not play out at all if conditions change. The question isn't certainty. The question is probability and asymmetry. What's the probability this thesis plays out versus the downside if it doesn't? If silver goes to 50, that's a 78% gain from 28. If it goes to 100, that's 257%. If it somehow reaches 200, that's 614%. The downside? Silver's cost of production floor is roughly $19 to $21 depending on mine and byproduct credits. So absolute worst case, maybe 30% downside if everything collapses. That's asymmetric. That's the kind of risk reward that makes sense even if probability is relatively low. The silent transfer of wealth thesis is the meta-narrative that connects everything we've discussed. For 80 years, the global financial system has run on dollar hegemony backed by U.S. military power, established institutions, and commodity pricing denominated in Federal Reserve notes. Bretton Woods ended gold convertibility in 1971, but the petrodollar system emerged where oil and most commodities trade in dollars, creating permanent demand for U.S. currency and allowing deficit spending without immediate inflation consequences. That system is fracturing. BRICS nations are discussing commodity-backed trade currencies. Saudi Arabia is accepting yuan for oil. Central banks globally are diversifying reserves away from dollars at the fastest pace in 30 years. China and Russia are settling bilateral trade in national currencies. This isn't conspiracy. This is openly discussed policy by finance ministers and central bank governors. If the dollar loses reserve status, even partially, commodities repriced in alternative currencies or commodity-backed systems would see explosive nominal price gains in dollar terms. Silver, as both precious metal and industrial commodity, sits at the intersection of monetary hedge and technological necessity. It's the perfect asset for a world transitioning from paper-based monetary systems to commodity-backed trade settlement. Whether that transition happens in 5 years or 20 is unknowable, but the direction of travel is clear. And the Eastern accumulation of physical silver, if that's indeed what's happening, represents a front-running of that transition. China isn't buying silver to trade it next quarter. They're buying silver because they understand that in a multipolar world where currency trust is broken, the nation with physical resources has leverage. The nation with strategic materials controls supply chains. The nation with commodity reserves can dictate terms. This is a wealth transfer from those who hold paper claims to those who hold physical assets, from those who trust the system to those who prepare for the system's transformation. From the West, comfortable in financial engineering and derivative complexity, to the East, focused on tangible production and resource security. The Shanghai inventory collapse might be the most visible signal of this transfer, but it's not the only one. Look at gold. Central banks bought more gold in 2022 and 2023 than any period since 1967. Who's buying? China, Russia, India, Turkey, Poland. Who's not buying? US, UK, Western Europe. The pattern is unmistakable. Silver is following the same logic, but with the added dimension of industrial criticality that gold lacks. What makes this moment unique is the convergence. Industrial demand explosion, supply deficits, inventory collapse, geopolitical tension, currency instability, energy transition mandates. Each factor alone would be significant. Together, they create conditions where a commodity that's traded in a predictable range for a decade could experience a revaluation so swift and severe that it catches entire markets off guard. $200 silver isn't just possible. Under certain scenarios, it's the logical outcome of math meeting reality. The question is timing. Markets can remain irrational longer than you can remain solvent, as the saying goes, but they can't remain irrational forever when physical shortages become undeniable. By the time mainstream media covers this story, by the time Bloomberg runs front-page features on the Shanghai silver crisis, by the time congressional hearings investigate COMEX delivery problems, by the time your neighbor asks if they should buy silver, the move will be largely over. The gains will be captured by those who understood the signal and the data, who connected dots before the picture became obvious, who acted when asset was still cheap because the crowd hadn't noticed yet. This is how wealth transfers happen. Not when everyone knows, when nobody's paying attention except those few who dig deeper than headlines. If you made it this far, you're someone who digs deeper. You're someone who wants to understand markets below the surface narrative. That mindset is rare and valuable. The establishment doesn't want you thinking independently about money, commodities, or the future of the financial system. They want you passive, trusting, believing that everything is fine and the experts have it handled. But Shanghai's empty vaults tell a different story. The deficits tell a different story. The industrial demand explosion tells a different story. And maybe, just maybe, we're watching the early stages of a market dislocation that will define the next decade. By the time the headlines catch up, silver may already be gone.